Hi, welcome to Real Estate and Beyond with Rebecca Meyer, Realtor with Berkshire Hathaway, New Jersey Properties. Today, my guest is Dave Santini, one of my favorite guests.
Thank you.
So he is a CPA and my CPA, and he works in Washington, New Jersey. And today he's going to answer a question for us: how to make tax season less stressful.
I'm going to do my best.
Okay.
Obviously, no matter what you do, it's still going to stress some people out. But if we
Right.
can reduce that stress level, it obviously makes things go a lot smoother, and it makes it less hectic for the taxpayer.
Definitely.
I say what the biggest thing to do is try to be organized with your tax documents. You're going to be getting a lot of things in the mail, from different payers. Probably your W-2 from your employer, any 1099s if you're self-employed. So there's a lot of tax documents that are going to be, sent out by January 31st as per the IRS requirements. So I think if you could sort that out in a neat fashion, sort of like create a folder that says, 2022 taxes, and every time you see something come through the mail that's a tax document, just throw it in there so you don't have to hunt for it later and it doesn't get mixed up in the junk mail or bills, and you won't have to run around and look for those documents when they're needed. So that's the first thing. And I think the other thing is, if you had any big purchases or sales during the year, try to get that documentation together. If you sold a house, you want to keep that closing document. You want to give that to your tax preparer so they can determine whether you're going to have a gain, or a loss, and whether the exclusion is going to cover your gain or not. The $250,000 or $500,000 exclusion.
Right.
So, and also if you bought a house, that closing document comes in handy as far as adjustments. Taxes that you paid at closing, maybe interest that you paid or points that you paid at closing. So that does come in handy to have those documents readily available, and keep them with your tax information, because more than likely your tax preparer is going to ask for them once they find out that you had some type of sale or purchase during the year. And so and that would go for any purchase or sale, even if you sold your car. Most likely, most people, if they're selling a used car, or if they're selling it at less than they paid for it, so it's going to be a loss, and there's not going to be a gain. Even though personal losses are not deductible, like they consider that a personal loss, you still would want to report it as showing no gain, so that the IRS knows that there was no gain on it. So
Okay.
it's good to keep that information. If you were lucky enough to be able to afford and purchase an electric car, there's tax credits involved there, so you would want to keep that purchase information so your tax preparer can take advantage of that $7,500 tax credit that you would receive. So that's another good thing to keep track of. Also, any improvements that you made to your house, because there are some energy efficient tax credits still available. Like if you got a new furnace, new boiler, new hot water heater, alternative wood stove, that's another tax credit. A biggie is the solar tax credits. I believe that's still 30%. They were talking about bumping it down a little bit this year, but I believe it's still 30% tax credit on that. And also there's geothermal, which a lot of people don't think about. I mean, it's not very common, but there's also a big tax credit for that as well. So those are types, if you just happen to do those particular purchases and improve your house, why not take advantage of the credits associated with them? Because they're not automatic. You have to report them on your tax return. Otherwise, the IRS isn't even going to know you purchased those items that qualify.
It's true. Yeah.
Also, another thing to keep track of is college tuition expense. I don't know how. It's countless how many times I ask taxpayers if their children are in college, and they'll say yes, and I'll say, do you have a 1098-T? And they'll say, what's that? Well, the 1098-T is the tuition statement issued by the college to you and the IRS which confirms the amount of tuition you pay. And most undergraduate students, qualify for that American Opportunity Credit, which is, $2,500, which is a nice credit to receive. 1,500 of that is a pure tax credit. $1,000 of that is refundable. So if you say you have a zero tax liability, you'll at least get the $1,000 back as a refundable credit.
Okay.
So if you have that 1098-T, that's very helpful in order to determine how much tuition you paid and report it correctly on your tax return to get that credit. Obviously, stock sales. I know most brokers, especially after 2011, were required to keep the stock basis of stocks that they manage, right? So if you sell stocks or they sell stocks, they normally provide the basis, okay? But now say you inherited stock from a relative that was purchased prior to 2011, you may not have that basis. They're not keeping track of that basis because it was before the requirement, and your tax accountant's not going to have that basis either. So you'd want to try to get those records together, as far as if you sold those stocks, you want to make sure you get the proper cost basis so you don't overpay as far as the gain on those stocks. It might even be a loss, So you have to, and not going backtracking a little bit. If it's inherited stock, you get a stepped up basis. And what that means is your cost basis from the person that you inherited it from is no longer accounted for. That's not what's counted anymore. Once they pass away, you get a stepped up basis, meaning you get the fair market value of that stock on the date of death. So theoretically, if you sold the stock soon after they passed away, there would be no gain or loss because it would equal the fair market value which you would receive for it. Okay. And so that's an important consideration. A lot of people don't think of that. They may think that they received the same stock basis or whatever their parents or their aunts or uncles paid for that stock is what the cost basis is, but that's not true. When it's inherited, you get that stepped up basis. So that's an important consideration. So that's pretty much, those are like the big, I'd say one of the things I missed here that I should mention is contributions to retirement accounts, especially individual retirement accounts and Roth accounts. A lot of people have that automatically withdrawn, and they even fail to, tell their accountant about it, and that really needs to be, accounted for. Even if it's a Roth account that, is not tax deductible, you still need to keep track of those contributions to make sure that you're able to contribute the amount based on any phase outs or not, and so that's an important thing to make sure you tell your CPA about, if you made any of those retirement contributions, and also it's just a matter of keep giving, if your taxpayer doesn't have all the information on your dependents, you need to provide that. People may have a new baby that was born during the year, which is, even if that baby is born December 31st, you get the dependent exemption for the whole year, and I've seen where some taxpayers forget to mention they have a new baby, and it doesn't get picked up, and then they have to amend a return to add it. So, so you want to make sure, and also tell your accountant when divorces, unfortunately, create complications as far as claiming the children. So, and a lot of times, it's always in the decree, and a lot of times it switches back and forth, even in odd years, between the parents who gets to claim which children. That's something you have to tell your tax accountant too. He's not going to know, necessarily who you're able to claim from year to year. So you'll want to tell them, this year I could claim, my son, my daughter, and next year, it may be, a different situation. But you have to, make sure you tell your tax preparer that information so they can file an accurate return for you. And you don't want to, a lot of times if it switches back and forth and you claim the wrong one, somebody's return is going to bounce, whether it be your ex-spouse's return or your return, because the IRS is going to get two returns claiming the the same dependent. So you want to prevent those situations. That's off the top of my head.
That's great. That's a
what
good start.
That's a good start. Also, make sure any, medical expenses. A lot of things.
Yes.
A lot of times people they say, well, I don't pay enough medical expenses to deduct them. And and a lot of times that's true for federal, because it's a high limitation. It's 7.5% of your adjusted gross income, which is pretty hard to overcome for most people making a decent amount of money, salary and such. So, but New Jersey has a much lower limitation. It's only 2% of the gross income.
Wow.
And so that's a much easier limitation to overcome. In addition, a lot of people pay, their health insurance. They contribute to their health insurance through their employer. Well, New Jersey taxes that. They don't give you a tax benefit for it. So it's not pre-tax, and you're allowed to take that off of your New Jersey return. So that in itself may put you over the limitation. Then if you add any out-of-pocket expenses to that for you and your dependents, you may be looking at a pretty good deduction from the New Jersey return. And while we're on the subject of the New Jersey return, there's special, benefits for veterans, and so if you're not telling your tax accountant that you're a veteran, you could be missing out on a $6,000 deduction as a veteran, So that's another important thing to mention. Have you ever served in the military, right? One of the things that a lot of people forget, or they don't think they need, this is changing gears here a little bit, is say they had a period of unemployment during the year. They don't realize that they actually have to go and download that 1099-G. They're not going to get it in the mail, and they may know how much they received or think they received in unemployment, but it may not match that form exactly, and that form may have withholding on it that needs to be put on the return, federal withholding. It's not taxable by the state, so there won't be any state tax, but federally, there is a lot of times people do have withholding taken from it. And charitable, next thing, charitable contributions. A lot of people, don't realize that even though they don't itemize, the IRS now lets you, as a single individual, take $300 off the front page as an adjustment to gross income, and also $600 for a married couple.
Wow.
So if you leave that out, you're missing a deduction. So it's even if you don't think you can itemize, it's always important to include your medical expenses. Include your interest and your taxes, because your taxes, even if you can't get credit for them on your federal return because you don't itemize, the state gives you up to $15,000 as a tax deduction for those taxes. So you're gonna want to let your accountant know that you're paying that. And also rent. New Jersey gives you 18% of that rent paid as a credit, because they take into account that some of the rent you pay to real estate taxes, through the landlord paid the real estate taxes with the rent that you paid to the landlord. So 18% of that rent is considered real estate taxes, and that's a deduction. So you're going to want to include that information as well. And the charity, there again, even though you don't itemize, you can get that $300 or $600 or whatever it is. Maybe it's $500, but it's still a deduction off the front page of your tax return. And reduces your adjusted gross income. So that's my
that's great. That's good.
That's my thoughts for today. I don't know, maybe I left some things out, but you're always free. Anybody has any questions, they're always free to give me a call. I write an article monthly in Washington in the Messenger.
It's great.
So, and I have a lot of tax tips there, and also there in that magazine and on my website, I have those articles posted. So, if I missed anything, you can, get that information in other ways, either by contacting me or looking up my information on my website.
Thank you, Dave.
You're
That was
welcome.
really informative. Really,
Thank
really
you.
good. Really appreciate that.
Oh, no problem. My
I'm
pleasure.
Sure our viewers will
Hopefully
really
it makes
appreciate
tax season less stressful.
I hope so. Yeah, they can start working on it now.
Absolutely.
Yes. So thank you for joining us today at Real Estate and Beyond, Rebecca Meyer with Berkshire Hathaway New Jersey Properties. And thank you, Dave Santini, for joining us and just informing us on all this good stuff.
You're welcome. My pleasure.
And have a beautiful day.